Morning, Mike, and thanks very much for joining us again at Blue Notes to talk about ANZ's second submission to the Financial System Inquiry. At the core of the submission is the idea that the system has become more resilient, but ever more levels of capital are not really helping that story. What's the core issue there?
Look, I think the report, the interim report, I think laid out the right questions and asked the right questions. I think what has perhaps not been understood is what has happened since the crisis to now, and indeed what is proposed up to 2019. And the implementation of Basel III fundamentally has required us to keep a level of capital at 5.125%. If you look through from 2007 to 2019, the financial system is going to be significantly strengthened because each bank has to hold this level of capital. So looking back at 2007, we would not have even had the minimum capital that was required under Basel III. So if you like, the default rate or whatever you'd like to, the failure rate would be 1 in 1 probability. We have now significantly increased that so that right now, today, our failure rate would be 1 in 175 years. So that's pretty significant. By 2019, with the additional capital requirements that are being requested, for example, like the DSIB and other stuff, we will actually be at a probability of failure of 1 in 5,000 years. Now, I reckon that is pretty strong. So the call for further strengthening on top of that seems to me to be misunderstood.
The cost of the financial crisis to the real economy was astronomical, so you can understand why people don't want it to happen again. So how do we know, and what's the impact of going too far to safeguard the system?
Well, I think that's the trade-off. You have to determine what is the cost of this strengthening, not only to the consumer, but to the economy as a whole. Because, of course, these costs get passed on to your customers or to your shareholders. Somebody has to bear the cost. And I think the danger is that the effects and the unintended consequences on the economy are sometimes not properly thought through. If you contract the amount of credit available in the world, that clearly must reduce the growth in the world.
And Mike, this notion of big banks being too big to fail continues to resonate. People are obviously very concerned about it. Is there a better way to address the too big to fail issue than just simply more and more levels of capital?
Right. Well, I think, as I say, if you look at the capital level for a bank like ours, by 2019 we'll be at a 1 in 5,000 year probability, which is pretty strong. However, if there is this absolute need to remove this implicit guarantee that people will say that the big banks have, and you require further loss absorption, then a better way to do it is through bail-in of senior debt rather than adding more capital, because more capital just is going to drive the cost of credit enormously. Whereas bail-in, it has a cost, but it's a reduced cost. And the concept of bail-in is fairly simple. It means that the debt holders who hold senior debt will be, that money will go into the pot in the event of a failure of a bank, the same way that equity goes into the pot. But if you were to take our existing senior debt and make it all bail-inable, that would mean that the likelihood of a problem would go from 1 in 5,000 years, which is what we've got now, to about 1 in a million years. Now, you've got to say, is the cost of doing that really worth it?
Well, thanks very much for joining Blue Notes again, Mike. Talk to you soon. Thanks.
Good to see you, Andrew.